Hey, it is Gio with Strategic Edge Trading. Today we are talking about the on-chart risk manager and the protect the gold risk model. Okay, so real quick, just going to run through all the features, then we'll talk about how to properly utilize it. Okay, so in the settings panel, and the easiest way to get to the settings panel always, because you're going to want to access this fast while you're in the market, is just double click on that data panel. Okay. There's two data panels that show. Up top, it gives you the session stats for Asia, for London, and for New York. Down here, it's just going to call out the session that you're in. I'm recording this in the evening, so this is currently the Asian session. Okay. How does it know what to tell me in this data table? How does it get this data? Okay. Well, for starters, we're measuring by session because that is I don't want to include, New York stats in my Asian trades. It doesn't make any sense because the volatility is so much different, as we go from Asia to London to New York. Um, just the way that the market, whatever product you're trading is going to respond during those times is different. I mean, for example, let's pop over to something like crude oil. You know, you'll see that we're getting a lot more action in London than we are in Asia, right? And our targets are going to naturally adjust to reflect that. You'll also see that, it tells you when you're looking at the big contract that if you need to, hey, based on the approved risk number, you should be trading micros. Now, here's the thing. If you're on a micro chart and it tells you to trade micros, yeah, so I would thought gold would do it because gold has been doing it. If you're on a micro chart and it's telling you to trade micros, it means you can't afford to trade this this instrument just at all. Okay, because there's nothing smaller than one micro contract in these futures markets and the CME. Okay, so it's telling us right now. Well, good at MYM. Let's see. Ooh, I could trade a big contract. So YM, interesting. Nope, nope, Geo, don't trade Asia. Okay, so anyways, um, it's going to tell you that on average, when we're looking at MFE, MAE, what does that stuff stand for? Well, basically, if we're in a bullish structure, i.e., we are making higher lows and higher highs, higher lows and higher highs, right? If we're in a bullish structure or we're in a bearish structure, making lower lows and lower highs and lower lows, so MFE, maximum favorable excursion, it's going to measure, you know, peak to valley, how long that market structure ran. And that's going to be our maximum favorable excursion for that market structure. Conversely, it's also measuring the adverse excursions. Every time we have a pullback, but then it comes back to make higher highs, how deep did it pull back? Right? So the average maximum adverse excursion during this session is 16.4 ticks. The 60th percentile, which is what it defaults to, because I want you to live through the majority of all pullbacks. I don't want you to get shaken out for funsies, right? That just messes everything up. And that's, I think, why a lot of traders want to go in without stops. That's why I always want to go in without stops because it felt arbitrary. Every time I got stopped out and it kept going my direction, I was like so mad. Right? Well, I was right, and now I'm not paid for it. In fact, I lost money. That's true, right? But I don't feel that way with the Protect the Gold risk manager stop because it's not arbitrary. It's telling me that if it goes beyond this number of ticks, then statistically speaking, it's probably a failed trade, right? It's because the majority of all successful pullbacks will fall, for this session, will fall less than that number. Okay. So that is how we are determining the adverse excursion and the favorable excursion. I mean, you could try and calculate all this manually, but you'd have to literally do, you'd have to go back and look at the last 100 market structures that occurred in the Asian session, in the London session, the New York session, do all that math yourself. I mean, it's possible, but this tool gives you real analytical insights that are evidence-based that should give you some peace of mind that tell you if you got stopped out, well, thank goodness I got stopped out because I was probably wrong, right? When it comes to the MFE data, that's also useful because, yeah, I got clear skies bullish here, but if we measure this, like grab the ruler tool from from our valley to our current peak, we're at 207 ticks. Well, guess what? We're way over the average MFE for this time period. So right now we're in one of those statistical outlier moves. And I don't want to take a guess about whether or not this thing is just going to keep going forever, right? Doesn't benefit me to enter long here, right? Statistically speaking, this move has reached its conclusion, and me entering this late in it makes me silly, right? So knowing this is pretty useful in my opinion. Okay. Also, say you had just gotten that change of character, right? So now you have a bullish outlook because you have the change of character. We're making, we violated a lower high, we made a higher high, right? Great. That's fantastic news for somebody who's interested in being long here, right? But we know that from here to here, once again, use your little measurement tool. From here to here, well, we had already gone about half of the max, the average MFE, the average favorable excursion. So on a pullback, that makes this a good entry because now we're at less than a quarter of the average favorable excursion. That gives me a suitable amount of room to target for my TP. So I want to make sure I'm targeting a level that is at or around what makes sense based on where the market structure started. So just some insight pieces. None of that really matters. It's just a cool little additional thing you can do with the data. But back to actually protecting our goal. We're going to look at this panel down here. It's going to tell us when we double click on it, this is set to Central Standard Time because the indexes are CME futures. They're based out of Chicago. So it defaults to their time zone in TradingView. If you're trading a Globex product or, COMEX or, then you'll have to adjust the times accordingly to when those products are being traded and based on the native time frame of the product itself. So if it's New York based, then you're going to want to use Eastern Standard Time, etc. Okay. Down here, balance and available drawdown. Well, I'm going to reduce this. I'm going to reduce this from a $75 risk unit because this was set up for old Apex, but Apex just launched their new end of day drawdown accounts, and those have a slightly lower. I just got a new end of day drawdown PA, so it's a 50K. That gives me 2,000 in available drawdown. So we're gonna set our daily loss limit for prop traders. I recommend like 10%. You know, you don't have a giant available drawdown. You do need to be able uh, to have a reasonable stop loss. So, our per trade risk is reasonably low at about 10%. of our 2000 available drawdown. If you're trading a live personal funded account, I don't think that you want to lose 10% in a day. That number is probably more reasonably like a 4%. And the reason I say four is, if you got three trades in the clip and you're risking 1% per trade, I just always anticipate giving 1% to the market just for participating. So, that's going to be my fees, my commissions, my slippage, all of that is going to, be somewhere around at least 1% just because I stepped into the arena that day. So if I've got a 10% daily loss limit, 1% is auto reserved for fees, and then I've got 9% of the account remain, or 9% of my available drawdown in that prop account remaining to trade. I'm going to take that and I'm going to divide it by three, and that's going to give me my 1R unit, right? Because I want at least three trades in the clip. So let's say you had a, $25,000 personal account and you wanted to risk 4% per day. Well, your 1R value would be $250. You'd be risking 1%, and you know, that's what you're looking at. So that's how this all breaks out. We'll bring this back to prop firm standards. Boom, boom. Why three trades in the clip? Because your edge diminishes over time. I know some people are like, I'm a scalper. I like to take 100 trades. I mean, odds are you're not you're not killing it throughout the entirety of that. So let's try and limit it to something reasonable. And if you are one of those people who wants to take a bunch of trades, well then just you know decrease your R, right? So for me it's it's 3% in this scenario. But let's say I wanted to be a more high frequency trader. I didn't I wanted to have more than three trades in the clip. Then divide that remaining 9% by five. Divide it by six. It does not matter to me. Whatever that number is, however many trades you want to be able to take. But also keep in mind that if you were to do that and try and say double that up and give yourself six trades, well, then you'd only have $30 of risk per trade. Odds are you wouldn't be able to afford a stop anywhere. So I've kind of already optimized this for prop traders. That's who I see using this more than anybody else. So, um, just kind of bear that in mind. I've already done a lot of the math and the thinking for you. If you utilize the tool as it's intended, you'll stop yourself from making, decisions that ruin accounts, and you'll protect your upside when your edge is expressing itself positively. Okay, so. Uh, MAE percentile can be modified here. 60%, I think, is a really nice spot. If you want to live through 75% of all pullbacks, well, then you're just gonna have to be prepared to have a bigger stop. You know, that's all. That's all that means. But 60 is where I like to keep it. Um, so my stop loss multiple. So for some people, they want to have uh, super wide stops. So if that, let's say that I I don't really want to think about where my entries are. I just want to be able to just walk up, look at the chart, place my thing, and walk away. I might want to give myself a 2x stop loss multiplier and give myself more breathing room, because realistically, if I'm not entering in, some sort of pullback scenario where I'm seeking to give myself a more favorable entry, what if it just like from the second I push enter, it just goes against me? You can give yourself a little bit more breathing room if you want. Don't necessarily think it's necessary. I keep that at one personally, but it's all customizable for you, your tastes. Um, yeah, round to the nearest five, ticks. Uh, The change of character pivot length is fine at 5. You know, you could reduce it to 3, but most of my research says that 5 is a nice median point. Okay. Here you log your trade outcomes. So you log strictly in multiples of R. So here we know that my R is $60. So if I lost $55, then you do a little bit of math. Divide your 55 loss by 60 and go ahead and log your minus 0.91 R loss. Oh, minus 0.91. It does like a zero on those negatives or those decimals. Yeah. So um, now once I've put it here, it's not going to be entered into the data table for consideration until I hit trade one logged. Why? Because sometimes you have break even or scratch trades. So let's say trade two, I trailed up to break even, got stopped out. Trade two is now logged as a scratch. Okay. Let's say I lost the plot on trade three and I risked more than one R. I added to the position while I was in drawdown and then I took a full loss. So I lost minus 1.5 R. Well, guess what? At that point, you risk more than one R per trade. Your judgment is suspect. We're just going to go ahead and lock the vault. We're going to secure the vault, keep you out of it because we need to protect the gold. Okay. That's what the chart lockouts are for. It's not because you're bad. It's because human nature makes us want to go get stuff back, right? You had that 120 bucks in your account and now you don't. You want it back. Well, guess what? Right now, you are making poor decisions. It's already been demonstrated because you lost more than one arm. So we're just going to secure the vault. We're going to lock you out of the chart and come back when, for the next session, the next day, when, you had a good rest, you had a good meal, your headspace is right, you're ready to be patient and wait for your model or your setup to develop, you're back in it. But today, you keep trading, you're probably tilted, you're probably gonna blow it. Okay. So that's what happens when you risk more than one R per trade. But let's go back and say, oh, we actually lost one here, and then we lost one here, and then here we were in a little bit of profit. We moved the stop up to trail, and then we still got stopped out again. Okay. Well, it's going to be the exact same deal if you hit minus 3R organically through following the rules. We're still going to secure the vault. Why? Because your daily loss limit is uh, is is 10%. Okay. And we know that throughout the course of this, we paid fees. We had a little bit of stuff happen. So that's the 1% that we gave up as soon as we entered the market. And then, we lost our 3.4 R. It's done for the day. It's okay. 10% is recoverable. You can walk away after having lost, uh, 200 bucks on your PA account, and you can come back tomorrow and with asymmetric risk reward, like look here, on all of these trades, we're risking one R, but we had the potential to make up to three, right? So it doesn't matter. Tomorrow you come back, you hit one 3R banger off rip. Guess what? Today was already wiped off the face of the planet, right? And then so let's go ahead and run that scenario. We'll go ahead and reset this to default. So the next day happens, right? We honored our chart lockout yesterday. We didn't blow our account because we had a couple of bad. trade picks. Who cares? We are not tied to the outcomes of those trades. Once you generate a trade idea, that's it. It's a coin flip, 50-50. You were right, you were wrong. And if you were wrong and you controlled your losses, you managed your risk, and the next day you do the same thing. You come in and you manage your risk. But when we're talking about managing your risk, we're talking about giving yourself casino odds, right? Because over time, as long as I continue to survive, my equity curve will go up and to the right. I will be net profitable because on my coin flips, every time it's tails and I lose, I only lost $1. But every time it was heads and I won three, right? And even if my coin sucks and I'm only flipping heads 40% of the time, I am still net profitable. Okay. So in that probabilistic distribution of outcomes, that's completely out of my hands, right? I've placed my bet. We flip the coin. It's in the air. Well, when it comes my way, right, and I hit that 3R out the gates on the next day, well, yesterday was already wiped, right? I had to lose like 4 or 5 times to hit that minus 3R, but it only took me one trade to get it back. Well, then guess what? My next trade is a 2R winner. Let's say I was still targeting three, but I trailed out for two. And then let's say it happens where my next one is a small loser. We were in a little bit of profit. We trailed it up and then we lost a half R. And then let's say we hit another clear dub and we bagged ourselves another 3R. Let's go ahead and log that trade. What happens here? You get the good lockout. You got that high score day lockout. It's time to put your initials into the video game and you know feel good about today's performance. You're goaded. Your daily loss limit is 3R. You secured double that, more than double that. That's a high score day. Do not give back your edge. Yesterday, the probabilistic distribution of outcomes wasn't favorable. And rather than let it continue down or exasperate it and, double our position size and do crazy stuff, start trading without stops. No, none of that. None of that. Because mathematically, we don't care. And when I lose, I don't care. I am so detached from the outcomes of my trades. My only job is to come up with pretty decent ideas of why to enter. That's my technical analysis. And then beyond that, my only other job is to follow this panel because if I don't and I let the human ego side of me take over, well, then I blow up. And that's what happens consistently. So you've got the high score day kill switch, you got the vault secured kill switch. That's a negative outcome, but it's still a positive outcome because you secured the vault and you protected yourself. And then you've also got the protect the gold outcome, which would be like anytime you go more than 2R in profits, like actualized on the day, and then you give one back, it'll just lock you out. That way you can protect the winnings that you've still got, right? Like I already went up. I'm already up 2R, right? So if my R unit is 3%, I'm up 6%. Professional fund managers are seeking like 1% a month, and I'm up 6% on the day. Yeah, I'm done, right? I can feel good about that. Now, don't psych yourself out about the actual dollar part of this, right? Because all of that will fix itself. If you are consistent and you're nailing it, then this part doesn't matter so much. Yeah, yeah, my 2R is only $120. Who cares? If you're at Apex, you could have that multiplied by 20 on a daily basis, right? So does it feel so unsubstantial now? Now that it's, you know, instead of $120, it's a couple $1,000, right? It's all just scaling math. And the truth is that you cannot scale until you've given yourself casino odds. You've given yourself asymmetric risk reward. You've leveled the playing field so that you have statistically backed stop loss and TP, right? Like it's all right there for you to leverage and to use. You can go from being the gambler who walks in with no plan and walks out with no money to being the casino who just exists and lives and profits day after day after day. And that's going to be my recommendation for you. I hope that you guys go out there and kill it. No more blown accounts. Trade well. Looking forward to seeing all the success. I love getting emails from people who are telling me, about the great successes that they're having, or the big aha, light bulb over the head moments that they're unlocking by just honoring the protected gold risk model. Totally brightens my day, to decrease the time to proficiency for people who, are out here giving it their all, trying to make it in the markets. So, sending good vibes your way. Trade well, and I'll catch you on the next one.